There's a widespread misconception that centralized cryptocurrency exchanges are risk-free, but a quick examination of Bitcoin and other cryptocurrencies demonstrates why it might be unwise to keep your cryptocurrency funds on an exchange. According to HackerNoon, between 2011 and 2018, more than $1.65 billion worth of cryptocurrency assets were stolen from DEXs. Considering inflation, this adds up to a shocking $12.6 billion in losses, and these numbers keep going up every year. In spite of the fact that the most recent events surrounding the collapse of FTX are a big tragedy for the whole cryptocurrency industry, users should learn from this. We shouldn't forget that this is news regarding the bankruptcy of big, centralized trading platforms. A great number of people have noticed a striking similarity between the events that occurred in November 2022 with FTX and the situation with Mt. Gox cryptocurrency exchange. In 2014, that platform, which accounted for 70% of crypto trading, stopped working after a hacker attack. Unknown individuals were able to withdraw 650,000 Bitcoin from the site over a few years. The bankruptcy of Mt. Gox also had an impact on the rate of Bitcoin. Although it was trading above $1,000 in early 2014, it was approaching $250 in the second half of February. When we consider FTX, it's clear that not everyone was able to learn from 2014. But why are centralized cryptocurrency exchanges risky? Where did they come from? And what other risks do they pose to regular users? My name is Samuel John. This is Deltatheta. Let's find out. It's sometimes said that cryptocurrency exchanges are similar to stock exchanges. However, in reality, they differ quite considerably from the stock exchanges in New York or London, both of which have made it through more than one severe financial crisis. Governments heavily regulate stock exchanges, which contributes to the strict regulation of stock trading on the platform. However, cryptocurrency exchanges are structured differently. They are not regulated and are frequently structured much more flexibly. In fact, they're typically private businesses that profit by assisting small investors in crypto trading. Their profit is derived mostly from the commission charged on each transaction. Most of the crypto exchanges that occupy a leading position in the market, for example, Coinbase and Binance, nevertheless crossed out the main original idea laid down when creating the blockchain in Bitcoin. Bitcoin, like many of the original altcoins, was first thought to be developed for decentralization and financial independence from the control of governments, banks, and other intermediaries. Satoshi Nakamoto, the founder of Bitcoin, explicitly made this clear in his BTC white paper. The Bitcoin system's peer-to-peer network is exactly what is required for direct, free transactions between end users. On the other hand, decentralized cryptocurrency exchanges don't do much more than operate as financial intermediaries. They often make rules for users like know your customer verification that are worlds away from the crypto anarchists and crypto punks who raised the first cryptocurrencies. Now, on the other hand, cryptocurrency exchanges are the primary source of liquidity for the market. These big platforms are what make it possible to engage in extensive trading activities involving Bitcoin and other cryptocurrencies. This is the key to understanding why such trading platforms are so widely used. And then, two types of exchanges emerged: centralized, CEX, and decentralized, DEX. Centralized exchanges rapidly rose to prominence as the most popular market players. 7 of the top 10 exchanges in terms of trading volume are centralized. But, as usual, this is a two-edged sword. Customers gain simplicity on one hand while losing control on the other. You do not, for example, bring money straight to the stock exchange. You trade through a broker who debits your trading account when you purchase assets and credits it when you sell them. The centralized exchange, on the other hand, acts as both a broker and a bank. It accepts client funds and turns them into cryptocurrency and vice versa. Up to $50 billion in client funds and cryptocurrency assets were held by FTX. Additionally, it performed the functions of a bank by taking deposits and making withdrawals of cryptocurrency. There's only one issue to be concerned about, and that is the fact that customers were unaware of the banking aspect of FTX, and hence did not provide their agreement to this. In addition, In contrast to the same institutions, FTX was not required to complete any kind of reporting. It is alleged that the creator and owner of FTX borrowed assets from his customers to promote other projects. This individual had access to his customers' wallets as well as their user keys. Unfortunately, by the time the clients discovered how little power they had, it was too late. When the system failed, FTX just stopped allowing customers to withdraw assets from their accounts to prevent further losses. Like conventional stockbrokers, crypto exchanges make money from commissions on every trade they make. Thus, they have the motivation to maximize trading volumes. FTX accomplished this with an intensive advertising campaign that featured celebrities and athletes. The exchange has spent over $375 million on marketing and support since its establishment in 2019. These operations included, for example, the purchase of the rights to the name of the stadium where the Miami Heat, a basketball team in the American National Basketball Association, plays. Such marketing contributed to creating the illusion that FTX and other exchanges are safe and that the user does not risk anything by investing their money. Without such marketing, it's unlikely that the value of the cryptocurrency market would have risen from $10 billion in 2014 to $876 billion in 2022. There's a saying among crypto investors: if the key is not yours, then the coins are not yours. Everything is very simple. This means that your cryptocurrency assets are at risk until you give them access to suitable self-storage and put them in your own wallet, for which only you will have the private key. States are enacting new regulations as centralized cryptocurrency exchanges gain popularity and capitalization. The rules are frequently related to the battle against cryptocurrency anonymity. As a result, several exchanges impose stringent procedures for user verification, such as the submission of a passport and other personal information. To understand why states are enacting such strict regulations, consider the case of the Indian cryptocurrency exchange WazirX and the well-known Binance. The final line is that the India cryptocurrency exchange WazirX was accused of money laundering in 2021. Additionally, it is important to note that since 2019, Binance, the biggest cryptocurrency exchange in the world, has owned this business. It's worth mentioning, however, that throughout the investigation, Binance's founder and CEO indicated that he did not own the India-based platform WazirX. Nishal Shetty, the Indian creator, contested this, claiming that Binance had bought WazirX. In reality, Nishal Shetty is correct in this case, as Binance released information regarding the acquisition of WazirX on his blog in 2019. Here's what that said. The acquisition of WazirX demonstrates our commitment and dedication to the Indian people, as well as the expansion of the blockchain ecosystem in India, and is another step forward in attaining financial independence. When WazirX ran into issue during the investigation, Binance's founder and CEO, Changpeng Zhao, stated in a series of tweets that the company has been trying to conclude a deal for the past several years, but hasn't finalized the agreement yet, citing several problems which he declined to explain. The Enforcement Authority of India, ED, has opened an investigation against WazirX. The company was reviewed for violations of the Indian Foreign Exchange Act, or FEMA. The Times of India says that the agency found strange transactions while looking into illegal online betting apps run by Chinese users to launder money. By changing rupee deposits into their stablecoin Tether, USDT, the suspects intended to launder $7.8 million in illegal profits. The stablecoins were subsequently transferred to Binance wallets. As a result, India's Financial Crime Enforcement Agency, the Enforcement Authority, ED, froze more than $1.5 million in cryptocurrency. Due to WazirX's cooperation and active anti-money laundering (AML) inspections that led to the banning of suspicious accounts, ED unfroze WazirX's assets. All of these events have had a significant impact on the company, whose revenue has decreased by 97.99% since the beginning of 2022. In general, the Reserve Bank of India insists on a complete ban on cryptocurrencies. A risk that isn't often immediately obvious to the majority of customers. If you adhere to the established safety procedures, cryptocurrency, such as Bitcoin, may be considered a rather trustworthy asset. In the sequence of transactions that take place between two users, the weak link is represented by the trading platforms. Attackers can locate a flaw in the source code of a certain platform, obtain access to a user account, or employ social engineering techniques. In a nutshell, they have an entire array of weapons at their disposal to steal cryptocurrency. And because CEX exchanges are the primary location where money is accumulated, they will inevitably be the first targets of any attack. If you don't trade often, it's best to move a lot of your savings outside of the exchange and into an external wallet. For example, cold hardware wallets. They are independent external devices that are linked to a computer or mobile device through USB or a radio signal. The key benefit of hardware cryptocurrency wallets is that they do not require an internet connection to operate. You can connect cold storage to your computer, transfer cryptocurrency to it, and then unplug it. After that, the cryptocurrency will be fully stored on the physical device. This nearly eliminates the risk of a hacking assault. The CoinSecure crypto exchange is one example of a hacking assault. It was shut down after losing more than $3.5 million in a huge break-in that was blamed on its chief security officer. The company stated in a message on its website at the time that it had lost substantial amounts while extracting Bitcoin Gold for distribution to consumers. The event permanently damaged investor faith in the Delhi-based crypto exchange, which was created in 2014. As we can see, trust in centralized crypto exchanges is extremely low. Nonetheless, many feel that proof of reserves can be a cure-all for future crashes and restore user trust. Let's see whether this is the case. In response to the recent ignominious demise of FTX, crypto exchanges across the industry, from Binance to Crypto.com, are promising to display proof of reserves to increase transparency. The goal is to ensure that a similar catastrophe doesn't happen again. However, some industry leaders are concerned that proof of reserves is not as accurate as it should be, and here's why. If customers do not grasp the boundaries of what proof of reserves can and cannot prove, it might offer them a false sense of security. And, as we saw with FTX, a false sense of security has negative effects. Also, even if there is proof of reserves, things might go wrong. Some exchanges have recently been accused of shifting millions of dollars in funds to assist other exchanges to pass reserve audits. It's reasonable to believe that such actions will continue in the future. Furthermore, it is entirely possible that the exchange simply does not declare all of its duties. It is also important to note that proof of reserves cannot prevent hacks, which have become one of the most popular methods for exchanges and cryptocurrency initiatives to lose money over the years. Is there a dependable way to verify that coins are not lost by a trusted third party? Many industry experts believe that the best way to ensure that money is not taken by a third party is not to trust them at all. And here, it is worth asking the question, do we need centralized crypto exchanges at all? Perhaps now DEX will be able to replace CEX. The answer is yes. Numerous DEX or DeFi protocols provide features ranging from transactions to staking and fiat currency deposits and withdrawals. For fiat currency deposits and withdrawals, DeFi has MoonPay, Transact, and Wire, and many DEXs have integrated with their services. A large number of DEX-based protocols provide rates and other interest-earning services. In the product experience, major DEXs such as Uniswap, Pancake, and Dodo support charts and a built-in K-line tools interface. 1inch, 0x Protocol, Dodo, TokenLawn, and Paraswap have launched a limit order feature that is similar to the CEX pending order. The gap between DEX and CEX in terms of product features is already very small. There are gaps in user education and user habits between DEX and CEX, such as private key management and wallet interaction. Also, DEX has relatively little liquidity compared to CEX, but this will no longer be an issue over time. The DEX is undergoing rapid iteration and evolution. Whether it's product experience or liquidity, DEXs are maturing. This means that centralized crypto exchanges are actually unnecessary. Crypto exchanges are not like stock exchanges, and they are not secure. You risk losing everything if the worst happens, such as in the case of a company crash or a cyber attack. Any investment has risks, and the uncontrolled cryptocurrency market is far riskier than the stock market. So, remember these 3 golden rules. Number 1. Knowledge equals power. Learn about the structure of the cryptocurrency trading process. Learn about non-custodial wallets. Keep your secret keys in a safe place. Number 2. If you're going to utilize an exchange, DEX should be your priority. This one is simply more reliable. Number 3. Remember that in this ever-changing world, only risk what you can afford to lose. Do not put all of your money into cryptocurrencies. And, even more importantly, do not acquire them with borrowed money. We'll be posting blockchain-related content every week at varying levels, so make sure that you're subscribed, and we'll be seeing you next week. My name is Samuel John. You're watching Deltatheta. Thanks for joining us.